Imagine it's 28 February 2012. You are a 60-year-old business systems analyst living in Stockton, California. Your name is Barbara Partika. 6 years earlier, you put 20% down on a nearly new house with slate floors, a corner lot, and a deck that looked over a lake. Stockton felt like a city on the rise, the kind of place where families priced out of the Bay Area could still buy 4 bedrooms and a yard. You worked, paid the bills, and watched subdivisions spread over old farmland as if the city itself had decided it would never be poor again. Then Washington Mutual failed, your job disappeared, and the price of your $400,000 house began falling like a stone dropped into a dry well. Now the mortgage is still there, but the value underneath it is not. If you have ever wondered why something sold as security so often becomes a lifetime burden, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before, in different countries, under different flags, and it keeps wearing new clothes, so people fail to recognize it. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. That same day, Stockton City Council opened a long emergency meeting with a prayer. The mayor said, "Lord, we need your help." A city built on rising home prices was now staring at bankruptcy. In Barbara's neighborhood, houses that once sold for around $450,000 were changing hands near $100,000. The dream had not simply cracked, the floor had dropped away. This is the mortgage trap. It is not just about high monthly payments. It is not even mainly about interest rates. It is about a system that turns shelter into collateral, collateral into a speculative bet, and a basic human need into the engine of a debt machine. At first, the machine feels generous. It offers access, speed, and the warm language of opportunity. People are told they are getting in before prices go even higher. They are told they are building wealth. They are told renting is dead money. Then the same machine asks ordinary households to carry risks they cannot see and losses they cannot escape. And this is why the story matters. A mortgage can be a useful tool. For many families, it has been. But in every major housing mania meaning a period when prices rise so fast that people stop asking whether they still make sense, the mortgage stops acting like a bridge and starts acting like a hook. It pulls buyers forward in time. It lets them spend tomorrow's income today. When millions do that at once, prices rise, loans grow, and the next generation has to borrow even more just to stand in the same kitchen their parents once bought on one salary. That is how a society quietly turns citizens into debtors, not overnight, not with a crash at first, but with a smile, a key, and a signature at the bottom of the page. Before we go further, there is something important to understand. Housing bubbles do not begin with greed alone. They begin with a simple change in the cost of borrowing. When money is cheap, monthly payments look smaller. When monthly payments look smaller, people can bid more for the same house. When people bid more, sellers raise prices. Banks see rising values and feel safer lending even more. Politicians like the boom because homeowners feel richer. Builders like the boom because demand looks endless. Families like the boom because the neighbor who bought last year suddenly looks smarter than the neighbor who waited. That is the mechanism beneath the surface. Think of it like a staircase that keeps rising under your feet while someone tells you the building is getting shorter. Credit makes houses seem more affordable in the moment, but the extra borrowing power gets baked into the price. The relief is real at first, then it vanishes into the sale price, and what remains is a bigger debt tied to the same walls. In calm periods, the system can work. In boom periods, it becomes a treadmill disguised as an escalator. People think they are moving up. In truth, the steps are just moving faster under them. Then the second layer appears. Loans are no longer kept by the local bank that knows the borrower. They are bundled, sold, refinanced, or linked to short-term rates. That means the person signing the mortgage often bears a risk created far away. In the United States, risky loans were bundled into securities, tradable packages of debt. In Spain, households were exposed through variable rate loans, which means payments could jump when interest rates rose. In Japan, land itself became the sacred collateral, the magic object everyone believed could not fall. Different tools, same illusion. Rising prices make lenders feel wise. But rising prices caused by easy lending do not prove the loans are safe. They only prove the music is still playing, and here is the secret key that unlocks everything. The trap is not that people borrow. The trap is that the system teaches them to borrow against prices that were created by borrowing in the first place. It is like building a tower out of mirrors and then using the reflection as proof the tower is strong. Once you see that, whole decades of economic history start to line up. This brings us directly to the first part of the story. The United States in the 2000s is often remembered as a banking crisis. It was that. But before it was a banking crisis, It was a household debt story. From 2001 to 2007, mortgage debt per American household rose more than 63%, from about $91,500 to $149,500. National mortgage debt almost doubled. That is a staggering change in just 6 years. It meant the country was not simply building more houses. It was loading more debt onto each house, like adding floors to a building by making the foundation thinner. At the same time, the culture changed. Home ownership was no longer just a life milestone. It was marketed as an identity, a retirement plan, and a moral virtue. If you rented, you were told you were falling behind. If you owned, you were told your house would work as hard as you did. Television channels flipped houses like toys. Mortgage brokers appeared in strip malls and over lunch tables. In some neighborhoods, people bought second homes they had never seen, betting they could sell them to someone even more eager a few months later. Now, here is where it gets interesting. The most dangerous loans were often sold with soft language and sharp teeth. Adjustable rate mortgages sounded flexible. Interest-only loans sounded manageable. No documentation loans sounded convenient. In plain English, many of these deals worked like this: low payment now, much higher risk later. People qualified based on a teaser rate, a temporary low rate that made the first months look affordable. When rates reset meaning the payment formula changed and the bill jumped, many households found that the mortgage they had signed was not the mortgage they thought they had. The official record later laid the numbers bare. In 2009, the year foreclosures peaked, 2.8 million mortgage loans were in foreclosure, almost 4 times the number in 2005. Between 2006 and 2013, about 10.5 million people had foreclosures show up on their credit files. One government inquiry found that 83% of the mortgage securities given top 8AA ratings in 2006 were later downgraded. Think about that. The labels said safe. The reality was the opposite. It was like finding out the lifeboats on a cruise ship were made of cardboard. Barbara Partika's story mattered because it was so ordinary. She was not a cartoon speculator. She put 20% down. She bought a house, got a job, and did what people are told responsible adults should do. Then the chain snapped somewhere else. Washington Mutual failed. Jobs vanished. Home values halved in less than 2 years. She sent out 80 resumes and heard nothing back. She could not get the bank to agree to a better mortgage. She could not sell easily. The exit doors narrowed just when the room started filling with smoke. This is what ordinary people actually experienced in the American bust. Not abstract graphs, calls not returned, fees added to missed payments, houses left empty on once busy streets, families doubling up with relatives, children changing schools, retired parents co-signing for grown children, entire cities like Stockton losing tax revenue as rising prices reversed and the boom drained out of the ground. The housing market was supposed to feel solid. Instead, it behaved like a frozen lake in spring. It looked firm right up until whole neighborhoods began sinking through it. And this is where history gets uncomfortable. The system rewarded the people who created volume, not the people who created safety. Mortgage brokers got paid for making loans. Banks made money bundling loans. Ratings agencies made money blessing the bundles. Homeowners were told they were getting rich because the number on a statement kept rising. Everyone was dancing around the same fire, warming their hands on the same illusion. But the fuel was household debt. When house prices fell, the trap became clear. A family with a small fixed payment and large savings could wait. A family with thin savings, unstable income, and a loan based on a false future could not. The same house could be a home for one household and a financial minefield for another. That is why mortgage booms create such cruel inequality. The houses look similar from the street. The balance sheets inside them are worlds apart. Here's something I want you to think about before we go further. At what point does the dream of ownership stop being ownership and start becoming rent paid to the bank, with all the risk still sitting on your kitchen table? Drop your answer in the comments. Seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. This leads to the second part of the story. Spain before 2008 was not America with different weather. It had its own twist, and that twist made the trap even harsher. Through the long boom, Spain built houses at a furious pace. The total housing stock reached about 560 units per 1,000 people, high even compared with countries that also attract second home buyers. Yet house prices were estimated to be 20 to 32% above their basic economic value. Households piled in anyway because the system seemed to reward speed. Delay looked like surrender. There was another danger hidden in the paperwork. Almost all Spanish mortgages were variable rate, tied to short-term market rates. That meant buyers were not just betting that prices would stay high. They were also betting that borrowing costs would stay friendly. It was a little like rowing across open water in a boat whose floor could rise or fall with the tide. You might still reach the other shore, but you had less control than you thought. Young workers were especially exposed. Spain's labor market had a sharp split between secure workers and temporary workers. Temporary means easier to fire, less protected, and often the first out when growth slows. So the same young households encouraged to buy were often the ones with the least stable income. Credit gave them a front door key, but the floorboards underneath were already weak. When the crash came, it was not just a price correction, it was a legal trap. In many parts of the United States, handing the house back could wipe out most or all of the mortgage pain, depending on the state and the loan. In Spain, many borrowers lost the house and kept the debt. That is called full recourse, which means the lender can still chase you for the unpaid balance after repossessing the home. The house was gone. The chain stayed on. The numbers were brutal. Human Rights Watch reported that banks initiated 438 foreclosure proceedings between 2007 and 2011. Courts ordered repossession and eviction in 166,716 cases from 2008 to 2011. In 2012 alone, the Bank of Spain reported 39,351 repossessions of primary residences. In just the first half of 2013, another 28,170 primary residences were repossessed. Those are not just files in a court system. Those are kitchens emptied, toys packed into boxes, school routes broken, and family photos carried out in plastic bags. And the stories inside the numbers were even worse. Eduardo Cachago, a 44-year-old construction worker from Ecuador, described real estate agents showing up at construction sites to push mortgage deals. Hilda M. said an agent even found a stranger to act as guarantor for a fee. Daniela Mello, a single mother of 3, was evicted in 2011 and spent a year living in a single room. Others discovered they were still trapped by debts they could not clear, their names blacklisted so they struggled to rent, buy on credit, or even get ordinary contracts. Imagine losing the house and still being treated as if you kept the luxury. Look at what happened next. The people hit first were not always the richest gamblers. Often they were families who entered late, borrowed high, and had the least bargaining power. Many had bought because rents were high, rentals were scarce, and buying was presented as the only adult option. This is how mortgage traps spread through a society. They do not require everyone to be reckless. They only require enough people to believe that the safe choice is to join the boom. Spain shows something many people still miss. A housing bubble does not only destroy wealth when prices fall, it can also lock households into years of legal and emotional aftershock. Debt outlives the euphoric moment that created it. The boom is a parade. The bust is paperwork, and paperwork can haunt a family longer than panic. Now consider the message this sent to a whole generation. Buy early or be shut out. Stretch further or live with your parents longer. Take the variable rate loan or miss the market. That is not a free choice in the meaningful sense. It is more like being told to board a train because the station is closing, while nobody mentions the bridge ahead may be unfinished. The third part of the story takes us to Japan, where the mortgage trap was woven into a larger national faith in land. In the late 1980s, Japanese asset prices surged with extraordinary speed. Stocks rose. Land values surged. In the 6 biggest cities, residential land prices in 1990 were roughly 2.6 times their 1985 level, and commercial land was about 3.9 times as expensive. Land was not just property. It was treated almost like sacred proof of national strength, a mirror that reflected nothing but confidence back at anyone who looked into it. Banks lent against that confidence. Companies borrowed against rising land. Households bought into a market where the basic assumption was simple. Land in Japan does not really fall. When people believe that, every new high price feels justified by the last one. A bubble is often just a story told so many times that it starts charging rent. Before we zoom out, hold this thought. Japan's case matters because it shows that you do not need American-style subprime chaos to build a housing trap. You only need a credit system that mistakes rising collateral for real safety. Collateral means the asset behind the loan, the thing the bank can seize if you do not pay. But if the collateral itself is inflated by easy lending, the apparent safety is partly imaginary. When Japanese land prices started falling in 1991, the decline did not stop after a bad season. According to research tied to Japan's own cabinet office, land prices had dropped to 50% of peak levels by 1994. By 2004, they had fallen further, to around 80% of the 1994 level. That means a long downward staircase, not a quick stumble. The bubble did not burst like a firecracker. It leaked like a punctured tank for years. This matters for households because mortgage pain is often imagined as sudden. In reality, it can be slow, cold, and exhausting. A rapid crash creates panic. A long drag creates paralysis. Families hesitate to move. Banks hesitate to recognize losses. Builders stop building. Young adults delay independence. A whole society begins living inside the shadow of yesterday's prices. Japan's lost decades were not just about GDP, gross domestic product, or the value of everything an economy produces. They were about time, years of postponed decisions, years of balance sheets too weak to restart normal life. And the banking system made it worse by turning cautious at exactly the wrong moment. Once bad property loans piled up, banks pulled back. Credit contraction, which means lenders becoming more fearful and stingy, hit the wider economy. Even good borrowers felt the chill. A mortgage boom often begins with loose money and ends with money hiding under the bed. For ordinary people, the result was a strange kind of captivity. If you bought near the peak, you were not just paying for a home. You were paying for an idea of land that no longer existed. The house remained. The neighborhood remained. The debt remained. What vanished was the price story that had justified all of it. It was like waking up to find that the ladder you had climbed was painted on the wall. Japan also reveals something counterintuitive. The pain does not fall equally on everyone who lives through the same collapse. Households with low leverage, meaning less debt relative to the value of what they owned, had room to breathe. Older owners with little or no mortgage could wait out price declines more easily. Families with savings and stable jobs were bruised, but not broken. Younger buyers who stretched at the top had far less margin for error. The same national slump was a deep winter for some and only a cold rain for others. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together, the same mechanism, different countries, different decades. Same result. In the United States, easier mortgage credit and financial engineering inflated prices until households were standing on debt they mistook for wealth. In Spain, variable rate loans and harsh recourse rules turned ownership into a trap that survived even after the house was gone. In Japan, land became the unquestioned collateral at the center of a credit boom that took years to unwind. 3 nations, 3 different legal systems, 1 basic machine. First, cheap or abundant credit pulls buyers forward. Second, rising prices convince lenders and borrowers that the system is safe. Third, the rising prices become the evidence used to justify even more lending. Fourth, when growth slows, rates rise, or jobs weaken, the extra debt stops acting like support and starts acting like gravity. At this point, the pattern becomes impossible to ignore. The boom was never just about houses. It was about time borrowed from the future and sold back to the present at a profit. This is why mortgage traps are so politically powerful. They make people feel richer before they make them vulnerable. A stock bubble can feel distant to someone who does not own stocks. A housing bubble walks into your street, your school district, your rent, your family arguments, your idea of adulthood. It changes what parents tell children. It changes when couples marry. It changes whether a city seems affordable or impossible. Collapse is not a fire. It is a river changing course. By the time most people notice, their daily lives are already downstream of it. There is another shared feature. In all 3 cases, institutions treated rising prices as proof of sound policy. But the historical record shows something else. A Federal Reserve study of industrial countries found that real house prices tend to rise about 28% in the 5 years before a peak, and then fall about 22% in the 5 years after. That is not every case. History is never identical. But the shape is familiar. The rise creates confidence. The fall reveals how much of that confidence was borrowed. And here is the part many people still find hard to accept. Mortgage markets do not simply reflect affordability. They help create the level of affordability or unaffordability people must live with. When lending is relaxed, buyers gain purchasing power. But if supply is tight, or if speculation joins the party, that extra power gets swallowed by higher prices. The loan meant to help you reach the house ends up moving the house farther away. It is like trying to climb onto a bus by giving everyone a taller ladder. Soon the driver just raises the door. This brings us to the human cost, because systems are always easiest to admire from a distance. Up close, they leave marks. The people hurt most are rarely the people with the best lawyers, the biggest buffers, or the oldest assets. They are first-time buyers, young families, temporary workers, migrants, single parents, and small business owners whose income moves with the local economy. Debt is a storm that breaks hardest on the houses with the thinnest walls. In Spain, this was visible with painful clarity. Immigrant workers were drawn into the boom through aggressive selling and thin rental options. When the market cracked, many lost their homes and still owed money. Credit blacklists followed them into everyday life. They struggled to rent a flat, sign a phone contract, or start over. One blow became 10. In historical terms, this is one of the cruelest features of debt crises. Loss multiplies. The same missed payment that takes a house can also close the door to ordinary recovery. In the United States, the human cost did not end when foreclosure notices stopped dominating the news. The New York Fed later estimated that there were 10.7 million fewer owner households in 2016 than there would have been under the 2004 homeownership pattern. Homeownership fell most for the young. Research tied student debt to part of that decline, but housing scars mattered too. The crash did not just wipe out wealth, it rewired behavior. A generation watched their parents lose homes, savings, or both. They learned that the front door key could also be a handcuff. That is one reason the title of this video matters. A mortgage trap does not only create current debtors, it also creates future non-owners, future late buyers, future adults who remain in rented rooms or childhood bedrooms because the market moved faster than wages and the last crash-poisoned trust. The burden spreads through time like dye in water. Even people who did not buy at the peak inherit the after effects through rents, tighter credit, slower wage growth, and delayed family formation. Ireland offers a haunting example of how long these wounds can stay open. After the 2008 property collapse, overall arrears eventually fell, but the hardest cases did not disappear. At the end of June 2020, more than 41,000 Irish mortgage accounts were over 90 days in arrears. Of those, 64% had been in arrears for more than 2 years. Nearly 1/3 were more than 5 years behind. Some were over 10 years behind. Think about what that means. Not a missed season, not a rough patch, a decade. A child could start primary school and finish it while the family mortgage remained in distress. This is where history becomes deeply personal. Long-term arrears are not just financial problems. They are frozen lives. Families postpone repairs. Marriages strain. Children absorb anxiety they cannot name. People avoid letters, avoid lenders, avoid neighbors, avoid hope. The mortgage becomes a ghost at the dinner table, always there, never invited. In Ireland, thousands of distressed cases were still trapped in legal processes years after the crash. The crisis moved out of headlines and into households. Now observe who walks away fine, or at least fine enough. Usually it is people with assets that rise early, people who bought long before the mania, people who can refinance on better terms, and people whose income is not tied to the most fragile part of the economy. In booms, established owners often gain paper wealth. Paper wealth means wealth that exists on statements because prices are up, even if nothing has been sold. Some sell near the top and lock in gains. Some keep homes with low monthly costs while new buyers shoulder huge debts. The system presents itself as a ladder. In practice, it often behaves like a drawbridge, lifting for those already across and rising higher for those still trying to reach it. And this is why housing debt reshapes class so powerfully. It divides people not only by income, but by timing. Buy in 1998 and you may look prudent. Buy in 2006 and you may look reckless, even if both families had the same habits and values. History can be unfair in that way. Timing becomes destiny, and the mortgage contract is the lever. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. What then did the survivors do differently? Not the lucky speculators who happened to sell near the top, not the institutions that got rescued. The historical record shows that households and communities that came through these periods with less damage largely shared a few characteristics. They did not treat rising prices as proof of permanent safety. They kept more margin than the culture around them thought was necessary. And when trouble appeared, they acted earlier than pride wanted them to. First, they respected leverage. Leverage means using borrowed money to magnify what you can buy. It can make gains feel bigger. It can also make losses fatal. Families that survived housing busts more intact often borrowed less than the bank was willing to offer. They bought below the maximum they could technically afford. They treated the approved loan amount as a sales pitch, not a command. That sounds simple. In a boom, it is emotionally difficult. When everyone else seems to be sprinting, restraint feels like failure. Historically, it was often the opposite. It was a life jacket. Second, they valued flexibility more than status. In Spain, households with more stable terms had more room when rates moved. In the United States, those who avoided cash-out refinancing, which means borrowing more against a rising home price to spend the difference, had fewer traps waiting later. In Japan, lower debt meant the long slump was painful, but survivable. The winners, if that is the right word, did not always have better predictions. Often they had better room to be wrong. That may be the most underappreciated lesson in all of economic history. Third, they faced reality early. They did not wait for shame to become catastrophe. In crises, delay can act like rust. It spreads quietly and weakens everything it touches. Families who contacted lenders early, cut spending early, sold non-essential assets early, or chose not to stretch into peak pricing often preserved options. Options matter. Once they disappear, every decision becomes more expensive. There were also people who survived by refusing the script entirely. Some kept renting when everyone mocked renting. Some lived with parents longer than they wanted. Some bought smaller homes in duller neighborhoods instead of chasing the boom. Some stayed liquid, meaning they kept cash and savings rather than tying everything up in one inflated asset. None of this made them profits. It made them less fragile. History is full of moments when looking foolish in the boom was the price of staying solvent in the bust. Current conditions in many countries rhyme with these older stories in unsettling ways. The OECD has noted that financial deregulation in earlier decades and the fall in real interest rates first made mortgages easier to access, but over time that easier credit was absorbed into higher prices. The same report showed that in several countries, most young adults now stay with their parents far longer than past generations did. In Korea, 79% of people aged 20 to 29 were living with parents in the OECD data. In Greece, it was 77%. In Italy, it was 74%. That does not prove a crash. History is not a fortune teller. But it does show what happens when housing costs outrun incomes for long enough. The debt trap can appear even before the loan is signed, by forcing the next generation to choose between delay and dangerous leverage. So return to Barbara Partica in Stockton. She did many things the culture said were right. She worked. She put money down. She bought a real home in a city that seemed full of upward motion. Yet when the larger machine reversed, those personal virtues were not enough to shield her. She took a job in Minnesota. She still could not get workable help from the bank. Her story was not unusual. That was the point. The trap was not built for a few reckless people. It was built into the structure of the boom itself. The final lesson is not that home ownership is always a mistake. History does not say that. The lesson is that debt tied to essential human needs behaves differently from debt tied to luxury. People will fight harder to keep a home. They will stretch further. They will believe better stories. That makes housing the perfect stage for financial illusion. The wallpaper looks warm. The contract underneath can be ice. And once a generation is taught that access to a normal adult life requires ever larger debts, the damage is bigger than any single foreclosure. It changes family formation, political anger, social trust, and the meaning of security itself. The mortgage trap turns debt into a rite of passage, then punishes people for passing through it. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.